Want to avoid paying tens, maybe hundreds of thousands of dollars in capital gains taxes when selling your investment property? A 1031 exchange is one of the most powerful tools in real estate available to real estate investors. But if you don't follow the IRS strict rules, you could lose out on these tax benefits entirely. I'm going to break down how to do a 1031 exchange the right way. I'll be sharing 5 of the biggest mistakes investors make that can cost them tens of thousands of dollars. I'll walk you through how a 1031 exchange works, and more importantly, I'll show you the 5 biggest mistakes that investors make and how you can avoid them. Before we dive into the mistakes, let's quickly go over how a 1031 exchange actually works. A 1031 exchange allows you to defer paying capital gains taxes when you sell an investment property. You reinvest the proceeds into another like-kind property. What that means is the property you sell and the property you purchase must both be used for investment or business purposes. You must use a qualified intermediary, sometimes called a 1031 facilitator, to handle the transaction. You cannot receive the sale proceeds yourself because if you do, the exchange becomes invalid and you're going to owe taxes. The value of the replacement property must be equal to or greater than the value of the property that you sold. Let's go over the 5 biggest mistakes that could ruin your exchange. Mistake number 1, missing deadlines. This is by far one of the common mistakes, and it happens more often than you think. The IRS has 2 very specific deadlines that you must follow. The first is the 45-day rule. Once you sell your property, you have 45 days to identify the replacement property, and you must submit this identification in writing to your qualified intermediary. The 180-day rule is you have 180 days from the sale of your original property to close on your replacement property. These timelines run simultaneously, which means if you take 45 days to identify by the property, you have 135 days left to close. The biggest mistake investors make here is waiting until the last minute to start looking for a replacement property. I recommend identifying properties before you sell. To avoid being rushed into a bad decision, you can also exchange into what's called a Delaware statutory trust. Mistake number 2 is choosing an ineligible property. Not all properties qualify for 1031 exchange, and this is where a lot of investors make very costly mistakes. To qualify, the property must be called what's like kind. The IRS defines like kind very broadly, so you can exchange an apartment building for a single-family rental or even raw land for a commercial building. Here's the catch: you cannot use a 1031 exchange to buy a personal residence or a vacation home. You can exchange mixed-use properties, but only the investment portion qualifies. If you are unsure whether a property qualifies, you need to consult with a tax professional or a qualified intermediary before you move forward. Talk with a tax professional and an exchange accommodator. Having these conversations beforehand can keep you out of trouble. All right, mistake number 3, holding or controlling the sale proceeds. This is a deal killer. If you receive the proceeds from the sale of your investment property, even for a day, the IRS will consider it a taxable event. To avoid these mistakes, you must use a qualified intermediary. This intermediary will hold the funds on your behalf and transfer them directly to the seller of your replacement property. To fully defer your taxes, your replacement property must be of equal or greater value to the property sold. All exchange proceeds must be reinvested. Mistake number 4 is underestimating the replacement property value. Mistake number 5, not having a backup plan. Many investors assume that once they identify a replacement property, they're good to go. But deals fall through all the time, and if you don't have a backup, you could be left scrambling at the very last minute. The IRS allows you to identify up to 3 properties. I recommend using that rule to your advantage this way. If the first choice doesn't work out, you have alternatives ready. A 1031 exchange allows real estate investors to defer capital gains taxes on investment property sales by reinvesting proceeds into similar like-kind property. My name is Alyssa Baker. I am not a financial advisor, so please consult a tax professional. If you have a project you would like to discuss, please reach out to me. I'm always open to new partnerships in commercial real estate.